opinions expressed by the program participants are their own and do not reflect those of Blue Line Futures LLC or their affiliates. The content is for informational purposes only and should not be taken as trading advice. Futures trading involves a substantial risk of loss and may not be suitable for all investors. Therefore, carefully consider whether such trading is suitable for your financial condition.
Hi, everybody. Welcome to episode 20 of the Macro Corner podcast, proudly presented by Blue Line Futures. I am your host, Paul Wankmueller. My co-host is Jannis Meindl. We are doing things a little differently today in celebration of our 20th episode. We will be focusing on 4 of our new tactical insights research reports featuring crude oil, natural gas, copper, and finally, treasuries. Welcome to the show, Jannis. Good to see you.
Hey, Paul. How are you doing today?
Doing great. Ready to dive into our special episode here. It's been great. Can't believe it's been 20 episodes already. Been flying by fast.
Absolutely. It's a blast each week, and thanks so much for all the listeners out there.
Absolutely. Thank you. Let's start off with crude oil here. So there are 2 correlated factors that I see that are to the recent price movement. They are the upcoming U.S. midterms and the completion of the SPR release. So what are those 2 things have in common coming up to the price here?
Yeah, so we definitely do know that the SPR has been highly politicized, and the Biden administration this week announced that there'll be 15 million barrels to be delivered from the SPR in December that will ultimately complete a total release of 180 million barrels of the SPR drawdown. And this is ahead of the midterm elections. We saw this historic trip by President Biden to Saudi Arabia and ultimately finding a lot of disagreement there in terms of asking the Saudis and OPEC plus writ large to increase production. That didn't find a lot of traction. And in turn, the Biden administration basically moved forward with even more aggressive SPR releases. A big theme here that we're watching is the pace at which they will keep draining the SPR. It remains a big question mark as to whether we will see a continued release schedule here after the midterms or not. We do know that gas prices at the pump are highly correlated to this administration's approval rating. So this has put a lid on prices while the underinvestment story in energy writ large continues to be front and center, of course.
Absolutely. And we have seen the price of gasoline come down from the highs, crude oil as well. But historically, they are still at higher than normal levels. So is that really something that seems to be working for them?
Yeah, I mean, one big theme on our podcast has been the rate of change. If you can make consumers feel just a little bit better, that will be, of course, to the advantage of the current administration heading into midterms. So that's what they're trying to do, even though we are still at extremely elevated levels comparatively to previous years. But then again, you turn to crude oil prices near the $80 mark, and that is not that high. Historically speaking. Also, when you consider that, you need to adjust for inflation over the course of time. So it's not as high as maybe the common narrative right now is, but at the same time, we do know that a combination of high inflation in goods overall, as well as in services that reflects in wages, combine that with relatively elevated energy prices, and that's not too good for the consumer. I mean, one of the things that we're also watching is the yield curve, and we'll come to that in the treasury section of today's podcast. But yeah, it is all playing together, and energy is one component of the inflation story. One important thing to consider is, yes, you have this lid being put on prices right now by the SPR release, but then what does that mean for inflation in 6 months, in a year from now?
Right. And everyone, you always have to remember crude oil is in almost every product that the consumer uses, from plastic to lipstick to even a lot of parts in cars, especially. Let's go on to another energy source, natural gas. And the term used for natural gas in the United States is Henry Hub. And we have seen recent pullback in prices in Europe. But where does the U.S. stand when it comes to export expectations, given that another political rhetoric that we have heard was, hey, we are going to help out Europe if we can. So where do we stand on that?
Yeah, so one big theme again has been the energy security story, especially as there's been a lot of tension in between the European continent and Russia, with pipeline flows in terms of natural gas from Russia to Europe slowing down substantially, some pipelines being at the zero bound as we speak. So the Europeans are trying to get themselves away from Russian gas dependence. And what that means is they will need a lot of LNG from elsewhere, including nations like Qatar, but one of the main suppliers going forward will be the US. And where's that LNG coming from? It's the Henry Hub export hub. That is the predominant benchmark for American natural gas prices. And what we've seen as of late is that the Dutch gas benchmark TTF, as well as the JKM, it's an Asian natural gas benchmark, those have come off, but still at multiples of what the Henry Hub benchmark is trading at. And heading into this invasion by Russia of Ukraine, we saw a run up in natural gas prices, as the anticipation was that because we have TTF and JKM explode to the upside, we'll have Henry Hub follow that price. But ultimately, what we need to consider when it comes to commodities as a whole is these prices are local prices, which means can you match supply with demand at that regional hub called Henry Hub? And the reality is that only at the end of 2024 onward, and then at the end of 2025, 2026-ish, we will see US export capacity that will then increase by about 60% compared to current levels. But up until then, it will be a question of how much is production in the US going to increase versus how much can exporters increase this export capacity. And we hit multiple constraints in that regard. We see that LNG tanker rates are hitting the upper bound of where they have been. In fact, I'm not exactly sure if they are at unprecedented levels, but extremely elevated. So we are bumping up against all these real world constraints here. And that puts a little bit of a lid on Henry Hub prices.
Sure. And that, just for our listeners out there, LNG stands for liquefied natural gas. It is a way to essentially pack more product into a boat and ship it over. If you've ever seen a picture, it's those boats with the large domes on top. So that is what we are talking about there. Let's dive right into copper. So copper is used, again, in a lot of facets of building an economy. It goes into the wires, going to carry electric. It also goes into a lot of pipes carrying water. So in that aspect, it's normally a bellwether in relation to the global economic situation. But now, where are the factors going forward, especially in relation to currencies and especially in China?
Yeah, so what we wrote in last week's Tactical Insights research report was that copper is basically sitting at the intersection of multiple macro and micro forces. On the one hand, you have China demand worries as a result of not only their real estate sector imploding, but also the zero COVID policy, things like that. On the other hand, you have Western central banks aggressively tightening policy. You can see that just looking at data like the 2-10 yield curve spread, that's basically indicating recession. Then you also have the green revolution going on, but that appears to be taking a back. I mean, you have energy security moving to the forefront, but at the same time, you have those green initiatives taking a little bit of a backseat. Green initiatives are ultimately a luxury that the Western world can't afford when things are really good. But you also have it in things like Xi Jinping's People Party Congress speech,
Right.
where he was basically saying we are taking a energy security first policy, and then greenification is taking a little bit of a backseat. You have that green, that little bit of a depressed demand on that side. You have to combine that aspect with things like Asian currencies being really weak. We have the Chinese yuan trade above 720 against the US dollar. Who knows where that's going? You have the Korean won trade at 1430, and you have the Thai baht trade at 38. So these are all currencies in the Asian space vastly weaker than in the recent past, and that's all impacting the demand landscape. And that's what we're watching.
Right. We talked about that in previous podcasts as well. There's a local export war or competition rather going on between the Pacific Rim. We can throw Japan in there as well, where trying to lower their currencies against the dollar to make their exports more attractive with regards to keeping their economies afloat.
Exactly. And then maybe looking at the flip side of things, you have an EM currency contagion sort of crisis, and that may lead to a lesser ability by some of these nations who are producing the commodities. You look at countries like South Africa, big on the platinum side, and their currency depreciating substantially against the dollar. But what does that mean for the supply side going forward is maybe a little bit more on the positive side as a result of a potential negative impact on the supply side.
Sounds great. And finally, let's move on to treasuries. I think this might be one of your favorite topics, but what does the yield curve and Fed speak mean towards going towards this November Fed meeting?
Yeah, so we will have the November Fed meeting here at the beginning of November. It will be, again, maybe Fed policy being guided by the markets rather than the other way around. We have the 2-year US Treasury yield setting new highs at 4.6. We have the 10-year trade at 4.2. We have the yield curve inverted at negative 38 basis points. So we have those yields remain extremely sticky. I think some of the market participants last week perhaps were watching that 4% level on the 10-year. The fact that it remained as sticky as it's been has been a little bit of a surprise, and that leads to some pressure on the stock side. But one predominant thing is how sticky will inflation remain? We see things like the Cleveland now cost being extremely elevated. I think a month-on-month acceleration in inflation of 0.8%. We also see that nominal GDP growth, so nominal being, of course, positively impacted by inflation, remain extremely sticky, and that means that the central bank needs to be more aggressive going forward. That means that yields need to rise, and how much pain will they allow to be inflicted on asset prices? The reality is that one of the Fed's main vehicles impacting inflation is asset prices. Unless they can impact asset prices substantially to the downside, they will not succeed in this fight against inflation, all things being equal. Of course, all things being equal is an assumption made by economists, not by market participants, and that will be on the radar of most traders here.
Right. And we've seen that core inflation get stickier and stickier. And we have seen the Fed stick to their policy, but we shall wait and see, my friend.
Yeah, and one main thing that I want to highlight, and Bill Baruch was talking about this in his midday market minute spots throughout this week, is foreign central banks selling U.S. treasuries. As those foreign currencies, as we talked about in relation to copper, as those currencies weaken, it will have an impact on foreigners' ability to hold treasuries and perhaps buy those treasuries. We saw for a really long time that nations like China and Japan were net buyers of U.S. treasuries. But if that dynamic reverses, that has its own implications.
And that's been going on for as long as I can remember. That's for sure.
Exactly. I mean, that was a big thing during the tariff war going on with China. And right now we see that have a real impact on yields. And especially during the opening hours of U.S. trading, we saw some weird things going on there.
Absolutely. Let's end it with that. Thank you very much, my co-host, Jannis Meindl. That was episode 20 of the Macro Corner podcast, proudly presented by Blue Line Futures. Thanks again, Jannis.
Thanks so much, Paul.
Don't forget, guys, the tactical insights are available in the description of the podcast, bluelinefutures.com, as well as attached to the email sent to clients. Not a client? Reach out to podcast@bluelinefutures.com for a 2-week complimentary trial of our premium research covering equity indices, bonds, metals, grains, livestock, and of course, tactical insights. Happy trading, everybody.
All opinions expressed by the program participants are their own and do not reflect those of Blue Line Futures LLC or their affiliates. The content is for informational purposes only and should not be taken as trading advice. Futures trading involves a substantial risk of loss and may not be suitable for all investors. Therefore, carefully consider whether such trading is suitable for your financial condition.